What is the value of a home? It's priceless for everyone because it's their home. We all know real estate can end up giving you supernormal return, but you will not get the liquidity when you want it on an average. The biggest exposure to any asset is real estate.
Yes.
If it's an investment, you need to know the appreciation, you need to know the income it provides, and also the liquidity that it can bring. The luxury real estate, I mean, there's a huge demand-supply mismatch.
Should you buy real estate companies instead of real estate?
You and I can own maybe a fraction of a mall, a fraction of a business center. Like how you have units for mutual funds, you have units for REITs over here. I think the most important aspect of this, story that we're talking about is what is the yield you're going after? Are you happy with the returns? Are you happy with the risk profile? Question is, how much is enough?
What's the value of a house? That depends on whether it's a home or an investment. If it's a home, you're not worried about how much someone would pay for it. Unless, of course, you're thinking of moving somewhere better. If it is an investment, there are several factors that come to mind. What is the area that you've bought this flat in? Is there an infrastructure project that is coming up or has come up in the vicinity? And this also assumes that you've paid a significant amount of money to purchase the flat. If it's outside Mumbai, you're paying about 1 crore. If it's in Mumbai or Bengaluru, the NCR region, you're paying over 1 crore, maybe a few crores. And that comes with its share of problems. There's an interest cost involved if you've taken a loan, and in all probability you have to do that. But what if you want to take exposure to real estate as an investment without putting that much money down? There are, of course, real estate investment trusts. They offer fractional ownership without the hassles of illiquidity and the humongous cost. But are they good investments? How do they stack up against infrastructure investment trusts? This is Moneywise on NDTV Profit, and we're going to talk about this today. Joining me in studio is Santosh Joseph, the founder of Germinate Investor Services. Santosh, thanks so much for taking the time.
Hi, Alex.
A bit of a long-winded introduction to that question, but the question that I want to start with is that there is this old world thinking, and it's proven true and good for a lot of big investors. They do it still today. If you've made money in the capital markets, particularly in the stock market, the thinking is you should take profit off the table and buy physical assets. A lot of people do that. Is that good? Is it bad? Is there merit to doing that? What do you think?
Largely what you said is routine for people, because if they made money in the capital markets, there's this tendency to feel that let me take some profits off the table and buy me something that's a lot more stable.
Yes.
On the other hand, there are some people who sell real estate and just get into a pot of money, and then they diversify by buying some digital assets, which is like equities. Now, what this tell you is that there is a cycle of life. Physical getting into digital assets, which is equities, and equities then when you sell, you buy physical assets. There is no right or wrong answer, but I think what is important is how you make the play work for you. The people who want to go in for stability is the one who have sold a lot of equities or profits from equities and consolidate by buying a physical asset, and they're happy because they know it won't at least materially collapse, and they know they're in possession of it, and there's a physicality attached to it. On the other hand, the people who have made money in real estate, when they go here, they're looking for simplicity, they're looking for diversification, and not to forget, yes, liquidity is a paramount factor, because we all know real estate can end up giving you supernormal return, but you will not get the liquidity when you want it, and it will not come easy.
Okay, so the reason I ask is that you keep hearing about luxury properties that are bought. Real estate companies, particularly those that are in the luxury space, are doing particularly well. And this is at a time when there has been a bit of a lull in certain pockets, right? We're still waiting for the interest rate cuts to pan out, for people to go out and say, okay, we want to take more home loans, we want to buy more houses. What do you think about that aspect, buying luxury real estate or real estate above a certain value as an investment?
Well, you can't take away from the fact that people, if they have that extra rupee, they will look at figuring out what they can consume, and therefore luxury real estate today is doing really well. And when you look at affordable real estate to luxury real estate today, you'll notice that the demand for luxury real estate is the one that's growing phenomenally, and it surprises most of us in the marketplaces. You take any large city, you talk about affordable housing to luxury housing.
There's a dichotomy.
Yes, the luxury real estate, I mean, there's a huge demand-supply mismatch. In fact, most will agree that many are short of supply. In fact, post-COVID, that has been the trend across the country in the large major cities. Now, when you look at that, there is just generally going to be an affinity to buy that. And you can't stop people from buying that. Question is, how much is enough?
Okay, so it's a good question to ask. The reason I'm setting this up, and I know that a lot of you tuning in will be like, why are you even asking about luxury real estate when it's unaffordable to begin with? To buy a small property in Mumbai, even if you go to the suburbs, it's going to cost you 2 crore if you go to Borivali. And I know this for a fact. So therefore, the reason I'm asking is to set up the next aspect of this conversation, which is that this might work for somebody who has a 1 crore portfolio, and for them to say, okay, I'll put 5 crore down, 6 crore down to buy a luxury property. Does it work for everybody else is a question.
It doesn't. See, it's about the position sizing. Like we say in equities or maybe even in investing, that you have to be mindful about the exposure that you take. It's not necessarily how the investment per se does. It's about your exposure and your risk measure. Even in terms of real estate, you can't be really overboard. Now, for someone having the need to buy a 5 crore where you put in some bit of your money yourself and then leverage the rest or borrow some, it may work, but not for everyone. And therefore, you have to pay attention to even the size, even when it comes to real estate.
Okay. In your opinion, what is too much of an exposure of real estate in an investment portfolio if you've decided that this real estate is an investment?
So let's put into context what we are experiencing right now in the country. Most people, on an average, the biggest exposure to any asset is real estate.
Yes.
And this is true for the country at large. But now with the emergence of non-physical assets like equity, you're seeing that slightly move the needle. For example, equities and mutual funds and financial savings products are increasing. I think if you're having 30-40% of your money in physical assets, in real estate, you're good. Slightly more than that, you're getting into the tough territory of managing liquidity or even managing how you manage the assets in itself. Because the people who do have a lot of real estate also have the challenge of, number one, maintenance, management, taxes, not to forget liquidity. While all this may be good, there's also a legal aspect to it that you have to be on top of the legal aspect of vetting all the documents, ensuring that you're on the right side of the law. Yeah.
Right. When you're buying. So therefore it comes down to what I wanted to talk about today, and it's a bit of a long setup to that, but fractional ownership of real estate. When they were launched, there was a lot of fanfare. They haven't taken off to the extent that I think some people had hoped, and I think policymakers are well aware of this. So you could have regulations that come through that bolster REITs. But as things stand, how can you describe the functioning of a REIT?
So what does REIT do for an investor is that it breaks down the process of putting your money into work in real estate with high liquidity, with simplicity and extremely low ticket sizes. Now, while I'm explaining this, let me also say that real estate is a fundamental predominant asset for most of us. And the definition of any asset naturally would be something that's a good store of value, something that appreciates well, something that gives you an income, and fourth, something that can also be easily liquefiable to buy something else.
Yes.
Now, when you look at this REITs, it actually solves all the four, because when you own a home, you don't get the rent and you're not going to worry about the appreciation, because you asked that question, what is the value of your home? It's priceless for everyone because it's their home.
Yeah.
But if it's an investment, you need to know the appreciation, you need to know the income it provides, and also the liquidity that it can bring. REITs do exactly that by creating this fractional ownership model that you and I can own maybe a fraction of a mall, a fraction of a business center, a fraction of a huge retail space, a fraction of a maybe IT says or something of that sort, maybe a 5-star hotel. Now, what does this do to an investor? You do not have to be worried about everything else to do with the asset, but all that you need to figure out is what you're buying at what price you're buying.
Okay, so does this work like that mutual fund? Ultimately it is fractional ownership of shares as well. If you're talking about an equity mutual fund, you buy units of the mutual fund, and the description of the value of that is the net asset value. And that mutual fund would invest in 500 stocks of 50 stocks. Similarly, a REIT would invest in properties in the commercial space or in a mall. Is that how it works?
Exactly. So that's a nice way of putting it across. So when you buy a mutual fund, you have a portfolio, you have a list of stocks, and each of these stocks have a certain weight. In similar fashion, when you buy a REIT, you have a developer who's got so many projects across various places, various cities, and mixed use development. Now, those are actually yielding you returns in the way of rental yields and lease yields. Those are accrued back to the investor. So the investor sees appreciation, investor sees income, and investor sees dividend coming out of those assets. Mind you, here the ticket size is really small. Like how you have units for mutual funds, you have units for REITs over here, and like how you get dividends in mutual fund if you chose that option. Similarly, you'll even get dividends here by the virtue of being an owner in REITs.
Okay, so and you've listed this out beautifully. The question that arises is, what are the different types of REITs in India? Because if you look at the global picture, there are residential REITs available, there are commercial REITs available, there are REITs that invest in the retail space, which is in malls. What is the landscape currently in India?
So from a real estate based investment trust, there are two largely. One, you have REIT, right? The one that takes care of office space, a little bit of retail space, malls, and even hotels, and all those are bundled into REITs. There are also public infrastructure, like from a toll plaza to a bridge.
That's
InvITs, right? So now in the REITs, you do not have a specific residential only or office space only. You have a slightly mixed unit right now coming up over there. The advantage that you have is that there is scope for these to grow and mushroom into bigger things. Like you spoke about in developed markets, you have specific REITs, maybe for warehousing, maybe for housing, maybe for low-cost housing, maybe for different housing projects specifically. They're all actually special purpose vehicles with a specific objective of what they're funding and what segment they're going after.
So right now, would it be fair to say that most REITs that are offered, and there are a handful of them currently, are commercial oriented?
The commercial, office space, retail, and lease oriented.
Okay. So you described that the way for an investor to make money in a REIT is twofold. Essentially, you're talking about capital appreciation, which happens when the value of the underlying, which is the value of the property that the REIT owns, goes up. And two, there is a distribution of the rental income that those properties generate, and there is a mandate to distribute most of it. So how does that work?
Generally, when you are an investor in a REIT, I think you get 2-3 incomes. Number one, you get the rental yield passed on to you. Number two, you also get a dividend income. Number three, there's also an interest income, because the money that you given towards the trust, which is the investment vehicle, also should pay you an interest for the capital that's given. So you have these three sources of income. Not to forget that the price that you buy could also appreciate, because the main vehicle that holds all this could also get a flip in their income up because of renegotiation or maybe more capacity being added in, and therefore that adds to the total net asset value.
Okay. So, and you've described three of these things, right? So you've talked about in that dividend, you've talked about rental, you've talked about interest income and
dividend income, rental income, and also capital appreciation.
Okay. So, and it's all housed in that dividend income that is paid every quarter?
Yes.
Okay. Now, how much are the REITs currently paying in India?
If you take a ballpark figure, that number is between 5.5 to 6.5%, and that number is paid out on a quarterly basis, then annualized. So therefore, the yield is, let's say, 6 as a ballpark figure. I also want to add that the capital gains happens between your buying price and selling price and the way the stock price moves. But the dividend income and the rental income, and even a certain portion of it, which is the returning of the distribution capital, happens on a quarterly basis.
Understood.
The payout is happening mandatorily on a quarterly basis.
So that's where it gets a little tricky to understand the tax implication as well, right? And the other thing, before we get to the tax aspect, is I want to talk about the price of these REITs, because they're all listed on the stock exchanges, and ultimately that's where it's available. Liquidity is something that is available because it's traded on the stock exchanges. The point that I want to ask is that a lot of these REITs have not done particularly well in terms of capital appreciation. Why do you think that is?
You see, there are a host of factors. The first things first is you cannot equate the price of real estate to the price of the REITs, because here largely it's based on rental yields. You're not going to every day take the value of the real estate under play. The benefit that you're actually playing for is the rental yields or the lease rentals that one is expecting out of it. Now that sometimes these are all on long-term contracts. You have to wait for the escalation to kick in, or to wait for some tenant leaving and another tenant coming, and sometimes you could also go through a small period where there is a tenancy issue over there. But largely this is not a proxy to real estate play only in terms of capital appreciation. Capital appreciation also happens, but it's not the primary reason. You get in here from a rental yield perspective. That's why the dividend distribution that happens on a quarterly is important, and largely you measure these for the dividend yields that they can give you.
So when you're saying that the dividend yield therefore currently is 6% or thereabouts, it's not very high, is it, Santosh?
It's not very high compared to what you would normally think that you should make in real estate, but think about it. But if you're looking for a stable income which you want to receive on a regular basis, compared to what you would get on rental yields across any residential real estate project across the country, it's still very good. And it gives you great amount of liquidity. Now, can you easily get a 6% kind of rental yield and not be worried about whether you will get it next month, not be worried about what is the liquidity factor, not be worried about how much money you have to put down, and not be worried about will your tenant leave you? That's the problem it tries to solve.
Okay. So when you're saying 6%, you're talking about pre-tax at this juncture. Is there a simple way to explain the tax aspect of this?
It is simple. So first things first is the capital gains. The difference between your buy price and sell price is a capital gain taxation. The other two,
and let's spell that out, because that's long-term capital gains for equity is more than 1 year.
Yes.
And you have the benefit of 1.25 lakhs,
Yes.
which would come into play here as well.
Yes.
And if it's beyond 1 year, any capital gains beyond 1.25 lakhs would be taxed at 12.5%.
Yes.
If it's less than 1 year, you're paying short-term capital gains tax, which is 20%.
Yes, absolutely right.
Okay.
Now let's come to the other two, which is number one, the dividend income. Now it depends on how the trust is structured. If they're taking the beneficial status of the way they're registered, then you will pay the taxes. But if you're not taking that, then it's tax-free in the hand of the unit holder.
Okay, I have not understood.
So let's assume that the trust is not taking any special concession. If your dividend income is paid, the dividend becomes taxed at your slab rate.
Right.
So assuming that dividends are taxed at your slab rate.
Right.
Second comes the interest income. Now it's simple that the interest rate becomes income in your hands. It's a business income and is again taxed at slab rate.
Right.
And capital gains we just discussed about. So these are three primary these are three primary heads of taxation that you will have to look at when you're in these REITs.
So therefore, this 6% that you're talking about, effectively it's income that is taxed at slab rate.
Yes.
Okay. So then you have to factor in, if you're in the higher slab rate, you're going to wonder, is this something that is appropriate? I guess a like-to-like comparison on rental income is also taxed at slab rate.
Exactly.
So therefore, there is parity. Okay. So the question that arises after that is, there is also this product called infrastructure investment trusts, which has a similar sort of a framework, but it allows you to invest in national highways. It allows you to invest in major infrastructure projects. Are there enough options, and is the yield similar?
The yields are slightly different over there because those projects are slightly long-termish in nature, and they're also public infrastructure. Now, when you look at this, both REITs and InvITs, the reason why it's still not caught the fancy of the regular investor is that they have not understood how to make sense of this into their personal portfolios. The yields are slightly different. In fact, sometimes you'll notice that in REITs you have a more stable dividend yield but a lesser price action. In the other one you have a slightly better dividend yield but lesser price action over there.
In
InvITs.
Right.
Now the reason that happens is because of the long-term nature of those projects. It could be a toll project, it could be some road project, it could be some highway project. Now what this does is it helps an investor participate in those kind of projects which is otherwise cut away from a regular investor's perspective. Now I believe that as we speak about these things, we are largely speaking so that people are aware and they get comfortable of these kind of investment ideas, which is outside the traditional realm of actually being involved in those investments, right? And so therefore, as these avenues grow, you will tend to benefit from accessing those specific and unique projects and those unique return streams that were not there.
How much would you say are InvITs giving at this juncture, and based on the data you've looked at, is it better than REITs?
So the typical income or the dividend income that you receive in InvITs are slightly better than REITs. They're about 2-3% higher than even the way the REITs are performing. But we haven't seen much capital appreciation over there yet.
Okay. And they're also taxed in the hands of the
It's very
investors
similar,
slab
the
rate?
tax is
Okay. Okay, so let's come to the crux of it, Santosh. If I were to ask you for advice, how would you suggest my participation in REITs and InvITs should go? Should I buy both? Should I consider investing in both? Or should I not?
So first things first, this is not a replacement to what normally we do with our need to buy physical real estate. Now, you need to buy a home, you need to buy a home, or you need to buy the second home because you want to kind of plan that into your financial planning, you would do that. But here is an avenue that you may want to consider as a part of your portfolio in terms of accessing these kind of real estate assets and income that would otherwise not be accessible to you. So you begin small, you build into it, and you see how it plays on to you. Are you happy with the returns? Are you happy with the risk profile? And finally, are you happy with how it adds value to your portfolio? Because here you're accessing assets, revenue streams and appreciation which was otherwise getting missed out. Now, and I think as we mature as an industry, and I'm sure the policymakers and regulators will do more to get more of these come in, you would have been ready in terms of an ideation, in terms of exposure to build more. Right now, we're not asking this to be a binary outcome saying don't buy real estate, buy REITs. This is helping. It's helping the cause of people who want this kind of exposure, who want this kind of returns. And some people also look at this as a proxy to fixed income in itself.
So which is why, if you're looking at it as a proxy to fixed income, it's a difficult argument to make depending on what bracket you're in and what product you're looking at. Even if you talk about liquid funds over the course of 15 years or even 5 years, 7 years, would be 7% plus, wouldn't they?
It is, right. So I think a good question. So what is a normal expectation? One, you want to access real estate as an asset class because these returns are coming on the back of real estate and their performance and the yields that they generate. One. Number two, you're also hoping that there'll be some bit of capital appreciation, even if it doesn't come secularly or linearly, it'll come in lumpily. So when that comes and when you add that into it, the IRR works out for you. So that over a long period of time, even if you can generate a 7.5 to 8% kind of a return, it is still negatively correlated to the other asset classes that you have and gives you the comfort that it is backed by real estate.
Okay. So the thesis exists. The thesis is that if everything is working simultaneously, there is a tailwind for the REIT, there is capital appreciation, and there is dividend distribution or dividend income. And all of that put together makes it a good proposition that has not yet panned out. Is there a possibility that with more REITs coming through, with real estate as a business improving and changing in nature, that this entire thesis plays out?
It will, and I don't know when it will, and what will be some of those key factors, whether it's going to be people changing their perspective around it or policymakers coming and making the deal a lot more sweeter. But in the developed world, we've seen that these are extremely popular,
Useful.
and at some level, people tend to appreciate this slightly more than even the aggressive and the credit space fixed income.
And that's because in those developed worlds, your yields are much lower.
Yes.
The
Fixed income yields are
products,
lower
yeah.
and the real estate backed yields are much higher, and so therefore they prefer this. And if you notice that there, the propensity for people to be over leveraged on real estate, like the way we are from a Indian context, is not there.
Yeah.
Their over leverage on real estate will be largely in REITs and InvITs and in fractional ownership of real estate than physical ownership of real estate in India.
Okay, last question. And this has to do with this idea that people have jokingly suggested, if you had invested in Titan instead of a certain amount of jewelry about 15 to 20 years back, chances are you would have made a lot more money. Of course, gold prices are up, as we've discussed on other shows, 15% over the last 10 years on a compounded annual basis. Does that exist for real estate? Should you buy real estate companies instead of real estate?
Well, that argument has worked very well. Instead of buying a piece of real estate or instead of buying a flat, if you bought the developer that sold the flat, you would have made multiple times over with higher liquidity and maybe with lesser taxes.
Yeah.
But when it comes to REITs, that hasn't yet played out yet, because see, that's not the apple-to-apple comparison that
Yeah.
we're going for. Here, you want exposure in real estate to give you an yield. So I think the most important aspect of this, story that we are talking about is, what is the yield you're going after?
And what you're looking for.
Yes.
Thanks so much, Santosh, as
Thanks,
always.
Alex. Pleasure.
I think ultimately the conclusion is that it does not take away the need for real estate. Eventually, you're going to have to live in your own home. That is the idea, and you work towards that eventually. If you do want that exposure to real estate as an investment, this is something to consider. Maybe not in its current form. Let's see how that goes. Thanks so much for joining me today.
Thanks, Alex.
All right, that brings us to the end of this edition of Moneywise. It's gotten you perhaps to think of a few things. Let us know what you think in the comment section, and do stay tuned. Lots more coming up on NDTV Profit.